The option Greeks are absolutely essential to master and understand early on when first starting out as an options trader. Now, that's because the Greeks will tell you how an option's price is expected to change when certain variables like time, the stock price, and implied volatility change. So, in short, the Greeks will tell you how your option position should perform given certain scenarios. Now, the first primary option Greek that we're going to talk about is called delta. Now, delta estimates how much an option's price will change with a $1 change in the stock price. So, delta is a directional risk measure as it tells you how your option's price is expected to change when the stock price goes up or down. Now, call options and put options have different delta values. So, first of all, call options have positive deltas, and that means that call prices rise when the stock price increases and call prices fall when the stock price decreases. Now, that's because when you buy a call option, you have the right to purchase shares of stock at the call option's strike price. And when the stock price increases, your call option will have a higher probability of expiring in the money and therefore being valuable at expiration. But if the stock price increases further above your call's strike price, you now have the ability to buy shares at a deeper discount compared to where they're currently trading, which explains why call options increase in value when the stock price increases and fall when the stock price decreases. Now, on the other hand, put options give you the right to sell shares of stock at the put option strike price if you purchase that put option, and therefore put prices fall when the stock price increases and put prices rise when the stock price decreases. Now, because of that, put options have negative delta values, which basically explains that exact relationship. So, a put option has a negative delta value, and that means that if the stock price increases, the put option is expected to lose value, and if the stock price decreases, the put option is expected to gain value. So let's go ahead and look at a couple of examples of how delta works. So remember, delta is an option's estimated price change with a $1 change in the stock price. So let's say we have a $5 option with a delta of plus 0.50. Now, as we know, call options have positive deltas, so in this example, let's say this is a call option. So let's say the stock price is at $100 when we buy that $5 call option with a delta of positive 0.50. If the stock price increases $1 to $101, the new option price is expected to be $5.50 because the option's delta is positive 0.50. So when the stock price increases by $1, we simply add the option's delta to the option price to get our estimated option price after that $1 increase. Now, on the other hand, if the stock price instead falls by $1 to $99, then the new estimated option price is going to be $4.50 because in this case, since the option has positive delta, we're going to subtract the option delta from the option price since the stock price fell by $1. Now let's switch things up a bit and look at an option delta of negative 0.25. Now, as we've just learned, put options have negative deltas, which means they're expected to lose value as the stock price increases and gain value as the stock price decreases. So if we purchase that $5 put option when the stock price is at $100 and the stock price increases to $101, the new put option's price is expected to be $4.75 because it has a delta of negative 0.25. Now that means if the stock price increases by $1, the option price is expected to lose 25 cents, and if the stock price falls by $1, the option is expected to gain 25 cents in value. So is delta actually accurate in practice? Well, to figure this out, let's look at a real example of a stock price change relative to the option price change of varying delta call options. In this chart, we're looking at a change in the S&P 500 ETF, which is SPY, and we're looking at the SPY call options with 25, 50, and 75 delta. So in this example, in the shaded region, SPY increased by $4. Now in this example, everything worked out perfectly, and if we look at the 0.75 delta call option, the call price increased by $3. So if we take 0.75 and multiply it by 4, we get a $3 price change, which is exactly what the 0.75 delta call option experienced. On the other hand, the 0.25 delta call option experienced a price change of $1, which makes sense since if we take 0.25 and multiply it by 4, we get a positive $1 price change, which is exactly what happened. Now keep in mind that things will not always work out so perfectly. but in general, delta does a very good job of estimating an option's price change when the stock price moves up or down by small amounts in a short period of time. So now we're going to move on to the second option Greek, which is gamma. Now gamma estimates how much an option's delta will change with a $1 change in the stock price. So it's easiest to understand gamma from the option buying perspective. Now when you buy options or have a long option position, the gamma position will be positive. Now that means call deltas will increase towards positive 1 when the stock price increases and fall towards 0 when the stock price decreases. On the other hand, put deltas increase towards 0 as the stock increases and fall towards negative 1 when the stock price decreases. Now to understand this in terms of probabilities, delta is sometimes used as an option's estimated probability of expiring in the money. So when the stock price increases, call options at every strike price have a higher probability of expiring in the money, which means their call deltas will increase. Now if the stock price decreases, call options at every strike price have a lower probability of expiring in the money, which means their deltas will fall towards 0. On the other hand, when the stock price increases, put options at every single strike price have a lower probability of expiring in the money at expiration, and therefore their deltas will approach 0 as the stock price continues to increase. On the other hand, if the stock price decreases, put options at every strike price have a higher probability of expiring in the money, which is explained by their delta values getting closer to negative 1. Now I know it's confusing to think of a negative probability of expiring in the money, so when looking at a put options delta and thinking of its probability of expiring in the money, you can just ignore the negative sign. So let's go through some examples and look at how gamma works in practice. So again, gamma is an option delta's expected change with a $1 change in the stock price. So let's go back to our $5 call option example, and let's say that option has a delta of positive 0.50 and a gamma of positive 0.10. If the stock price is at $100 when we buy that call option, and the stock price increases to $101, the option price is expected to be $5.50. However, since the stock price has increased by $1, the option's delta is expected to be positive 0.60 because the initial delta was 0.50 and the gamma was positive 0.10. So if the stock price increases by $1, the new delta is expected to be 0.60. Now that means if the stock price increases another dollar from $101 to $102, the new option price is expected to be $6.10, which is 60 cents higher than the $5.50 option price after that first dollar increase. Let's flip things around a bit and say we have a $5 put option with a delta of negative 0.40 and a gamma of positive 0.15. Now if the stock price is at $100 when we buy that option and the stock price falls to $99, the new option price is expected to be $5.40, and that's because the negative delta of 0.40 means the option price is expected to increase by 40 cents if the stock price decreases by $1. So whenever we have a decrease in the stock price, you're going to subtract the delta from the option price, and when we subtract a negative number, we end up with a higher number. And also, we subtract gamma from the option delta when the stock price decreases by $1. So if the stock price goes from $100 to $99 and the initial delta was negative 0.40, if we subtract 0.15 from negative 0.40, we get a new option delta of negative 0.55. Now that means if the stock price decreases another dollar to $98, our new expected option price is expected to be $5.95 because our initial option price after that first $1 decrease was $5.40, and with a new put option delta of negative 0.55, if the stock price decreases by another dollar, the option price is expected to increase by another 55 cents. So $5.40 plus 55 cents is an estimated price of $5.95. Now again, with a new delta of negative 0.55 and a gamma of 0.15, with that next $1 decrease in the stock price, the new option delta is expected to be negative 0.70. Now let's go through a real example using historical option data and visualize what gamma represents. Now in this chart, we're looking at Apple's stock price changes relative to a call and put delta with the strike price of $120. So on the top part of the chart, we're looking at the changes in Apple's stock price relative to that strike price we're looking at, and on the bottom we're looking at the call and put deltas for the 120 call and 120 puts on Apple. Now, as we can see here, in the initial part of the shaded region, Apple's stock price increases from $120 to around $133. During that time period, the put delta of the 120 put gets closer to 0, while the 120 calls delta gets closer to positive 1. Now again, if we think in terms of probabilities, the increase in the stock price from 120 to 133 results in a significantly higher probability of the 120 call expiring in the money, since the stock price is $13 above the strike price, and the put options delta goes towards 0 because the put option has a significantly lower probability of expiring in the money, since the 120 put is now $13 out of the money. Now, as we can see here, in the second part of the shaded region, Apple's stock price collapses from that price of around $133, and at the end of the shaded region, the stock price is at $115. Now, as we can see here, as the stock price collapsed, the 120 calls delta crashed from being above 0.75 to being at 0.25 at the end of the shaded region. And as we can see, the put options delta went from being close to 0 to negative 0.75 with the decrease in the stock price. Now that's because with the collapse in Apple's price to $115, that 120 call is now out of the money and now has a significantly lower probability of expiring in the money compared to when the stock price was at 133. But that 120 put is now in the money, and therefore the put options delta is closer to negative 1, which represents a higher probability of that put option expiring in the money. So in the simplest terms possible, I think of gamma as an option's changing probability of expiring in the money as the stock price increases or decreases. When a stock price increases, call options at every strike price have a higher probability of expiring in the money, which is expressed by higher delta values, and put options have lower probabilities of expiring in the money, which is represented by delta values closer to 0. And when stock prices fall, call options at every strike price have a lower probability of expiring in the money, which is expressed by deltas closer to 0, and put options at every strike price have a higher probability of expiring in the money, which is expressed by delta values closer to negative 1. But of course, we can just forget about the negative sign and think about the raw probabilities. The third primary Greek, and perhaps the simplest Greek to understand, is theta. So theta estimates how much an option's price will decrease with the passing of one day. Now, all options have negative theta values, and that's because as options get closer to their respective expiration dates, their extrinsic or time value component decays, which is expressed by theta. At expiration, options only have intrinsic value remaining, which means the extrinsic value will reach $0 by expiration. So theta is the Greek that tells us how much an option's extrinsic value is expected to decrease with each passing day. So let's go ahead and look at a visual example to see how theta works. So again, theta is an option's estimated price decrease with the passing of one day. Now let's say we have an option that is trading at $2.50 and its theta value is negative 0.10 or negative 10 cents. That essentially means the option price is expected to decrease by 10 cents with each passing day. So on the first day, the option price is $2.50, but with each passing day, the option price is expected to lose 10 cents. So with the passage of one day, the option price is expected to go from $2.50 to $2.40. And for example, if 4 days pass and nothing else has changed, then the option price is expected to decrease by 40 cents. So let's go ahead and visualize theta in action. So in this chart, we're looking at Facebook, and we're looking at the 105 straddle, and we're looking at the straddle's price as time is passing. So the 105 straddle means we're looking at the price of the 105 call and 105 put combined, and since Facebook is trading right around 105 this entire period, the 105 call and 105 put are mostly extrinsic value, which decreases over time as expiration gets closer and closer. Now, as we can see here, the 105 straddle starts around $10, and by the end of the period, Facebook is still right around $105, but that straddle price has decreased from $10 all the way down to around $4. So this example is about as perfect as we're going to get in real life because a stock price will never just trade exactly at the same price as time passes, and that means we're never going to have that linear option decay as theta would suggest, and as we looked at in the previous theoretical example. But in this example, we can see a steady decrease in the extrinsic value of these 105 calls and 105 puts as time passes. Now the fourth primary option Greek is Vega, which estimates how an option's price will change with a 1% change in implied volatility. Now all options have positive Vega, and that means that when option prices become more expensive, they have more extrinsic value, which leads to an increase in implied volatility. When option prices become cheaper, they naturally have less extrinsic value, which means implied volatility falls, all else being equal. Now getting a little more specific, Vega expresses how much an option's price is expected to change with each 1% change in implied volatility. So let's go through an example to illustrate this point. Let's say we have a $2.50 option and implied volatility is currently 25%. Now let's say that option's Vega is positive 0.25. That means if implied volatility were to change by 1%, the option price is also expected to change by 25 cents. So for example, if implied volatility increased by 1% to 26%, the expected option price would be $2.75 because we have the initial option price of $2.50 and we add that 25 cents of Vega with that 1% increase in implied volatility. On the other hand, if implied volatility falls by 1% to 24%, the new expected option price is expected to be $2.25, which comes from the initial option price of $2.50, but since implied volatility has fallen 1%, we subtract the 0.25 Vega to get our new option price of $2.25. Now, I typically don't like the standard explanation of Vega as I've just given because implied volatility does not control option prices. There's nobody that's turning a dial for implied volatility up or down, which is controlling how expensive or cheap option prices get. Instead, the change in option prices controls the level of implied volatility. So to say if implied volatility increases by 1%, the option price is expected to increase by X is backwards. So let's go back to our previous example and flip everything around to rethink how to interpret Vega. So again, let's say our option price is $2.50, implied volatility is 25%, and the option's Vega is positive 0.25 or positive 25 cents. If the option price were to increase by 25 cents, the new expected implied volatility is 26% or 1% higher. If the option price does not change and stays at $2.50, then the expected implied volatility is still expected to be 25%. Now, if the option price decreases by $2.25, then the expected implied volatility is expected to be 24% or 1% lower. Now keep in mind, these are option price changes based on no stock price changes and no change in time. So if the stock price were to stay exactly the same throughout a trading day and the option price is changed up or down 25 cents, then the expected implied volatility would change by 1%. So in short, if the option price increased by 25 cents in a given trading day and the stock price did not change at all, implied volatility is expected to increase by 1% because that option increased by 25 cents, which means it has 25 cents more of extrinsic value, and that is what implied volatility is representing, and therefore implied volatility is expected to increase by 1% since that option's Vega is 25 cents. Now on the other hand, if the option price decreases by 25 cents during that trading day and the stock price did not change, implied volatility is expected to fall by 1%. So always keep in mind that option prices, and more specifically an option's extrinsic value, is what is driving changes in implied volatility, and implied volatility is not driving option price changes. So to quickly recap all of the four Greeks, delta is an option's expected price change with a $1 change in the stock price. Gamma is an option delta's expected change with a $1 change in the stock price. Theta is the expected decrease of an option's extrinsic value with the passing of 1 day. And Vega is the expected change in implied volatility based on specific option price changes. If you want to check out some more of our options trading videos, be sure to check out these videos featured on this slide right now. Once again, I'm Chris from ProjectOption.com, and I sincerely hope you enjoyed this video on the option Greeks. I'll see you next time.